So I've been a pharmacist for 10 years now. And just like a lot of medical residents and physicians, and we come out with student debt. So I came out with $250,000 in student debt to complete pharmacy school, which was 3 years year round. And when I graduated, I just said, okay, I'm making six figures starting and I'm $250,000 in student debt. And I was never taught a single thing about personal finance. That was my baseline. And that's a lot of people's baseline, unfortunately.
Welcome to the Physicians and Properties Podcast, the show where we teach you how investing in real estate can give you the freedom to practice medicine and live life how you want.
Doctor!
Now, here's your host, Dr. Alex Schlow.
Hey everyone, welcome to another episode of the Physicians and Properties Podcast. Today we have my good friend, Dr. Stephen Nguyen on the podcast. He's a clinical pharmacist and he's just crushing it in the real estate investing space. This episode is going to be incredible. So let's get started. Stephen, how's it going?
Hey, Alex. Great. Excited to come and share my journey. I know you went to my podcast, so definitely excited to return the favor and be the one to talk this time versus ask questions.
Absolutely. I'm excited too, because I just kept getting these like little teasers and what you're doing and what you've invested in as we were doing the podcast that I was on. And your story, honestly, is way more impressive than mine and going to provide a lot of value. So thanks for coming on and sharing it with us today.
Yeah, no worries. Happy to share. And I always just say I'm just one step ahead of everybody, just including yourself. So you'll be surprised how much you can scale in 8 months.
Yeah, I'm excited to hear all about it. And I think the next 8 months are going to be really exciting and a lot of growth for a lot of people if they listen to some of the information that's going to be in this podcast. We'll just get started. If you don't mind, just tell us a little bit about yourself.
Yeah. So my name is Stephen. I'm a pharmacist. I graduated pharmacy school back in 2013. So I've been a pharmacist for 10 years now. And just like a lot of medical residents and physicians, and we come out with student debt. So I came out with $250,000 in student debt to complete pharmacy school, which was 3 years year round. And when I graduated, I just said, okay, I'm making six figures starting and I'm $250,000 in student debt. And I was never taught a single thing about personal finance. That was my baseline. And that's a lot of people's baseline, unfortunately. We're the same boat. We had to get good grades in high school and college. Pharmacy school, if you want to get a good job. Medical school, same thing. So I just graduated and my focus for the first 4 years was literally to pay off my student debt. So I literally just worked as much as I could. And I did pay off my student debt in 4 years. So $250K in 4 years paid off because that's all I knew. All I knew was debt was bad.
Yeah. Wow. Yeah. $250K in 4 years is no joke. How did you do it? How did you save that extra money to pay off that debt or work more shifts? How did you pay off $250K in 4 years?
Yeah. So what really helped me build my financial foundation, to be honest, was just not lifestyle inflating. Obviously, when I graduated as a pharmacist, I was still pretty young in my early 20s. So I didn't really lifestyle inflate. I just maintained that college mentality, your room share, and you still kind of eat Chipotle, stuff that's like really cheap. So what I did was I just created a plan. So I knew I was taking home like roughly around $6,000 to $7,000 a month. When I was renting, I just rented a room and that costed around $500, including utilities. And so I had a kind of a spread there, right? I had a spread of around $5,500. So at that point, you can figure out, okay, $1,000 for expenses to go out, eat, have fun, buy some stuff here and there. And then the rest was all savings. So that was about $4,000 to $5,000 a month in savings. And I just kept at that over that 4 year span while also job hopping a little bit to bigger hospitals where they paid more. So I would go from like $1,000 take home to maybe $8,000. But my living expense was very similar and my rent was very similar. So that's how I started off. And I just automated that. So every month I just saved and I would put extra payments into my loans. And another thing I did was I actually refinanced my federal loans. Interest rates were 7.5%, I think. For context, a mortgage is 4% back then. Federal student debt is higher. And I refinanced it from 7.5% to 3% using First Republic Bank. And that was huge, right? I dropped my interest rate by about 4.5%. Wow. So a lot more of my payments went towards the principal versus interest. And I was able to increase my income, continue my savings rate of about $5,000 a month. And you just kind of do the math. That's $60,000 a year. And you do that over 4 years, you have $250K paid off. So I know it sounds simple to say, but yeah, it just really requires a lot of discipline, to be honest, to do the plan, stick to the plan, and not be tempted to buy a new car, go on fancy vacations, and just ball out, for lack of a better word.
Yeah, absolutely. I think the longer that we can delay that lifestyle creep, the longer that we can delay the thought, hey, I'm a pharmacist or I'm a physician, I need to drive the fancy car and have the nice house. The longer that we can push that off, the better, whether that's paying off student debt or whether that's funneling all that cash into assets and income producing properties or investments. That's the way to do it. You did a great job and definitely took a lot of discipline, a lot of sacrifice over those 4 years. And let's be real, Chipotle is still fantastic, though, whether you have a lot of money in the bank or a little. And so if Chipotle is ever interested in sponsoring this podcast, that'd be fantastic. But it took a lot of discipline, a lot of time, and you did it, man, in 4 years, which is just incredible. How do you feel like paying off that $250K in 4 years sets you up for success for investing in the future?
Yeah, for me, like honestly, when I paid it off, it didn't feel as good as I thought it would. I think I was just very immersed into the process. And like I said, it's just really funny because like even to this day, like I'm a pharmacy director and pharmacists report to me. And even my pharmacists that I just hired who are new grads, they have nicer cars than me. Like Tesla is really popular now in California. So like everyone has like a brand new Tesla. And even me, I'm driving the same car I drove back in pharmacy school. Like 10 years later, despite building a huge net worth. After I paid off my debt, I just said, what's next? Okay, I had this huge goal and I just worked and slowly increased my income, moved up the corporate ladder to become a pharmacy director of a hospital. And I just said, what's next? And the most natural progression is you want to buy a house for yourself to live in, right? Because I didn't want to live with my parents anymore, or I didn't want to like share a room where I'm just paying like $500. I just kept the same mentality and I would just save up. In California, the average cost of a home is $800,000 to $1 million. So if you need 10% to 20% down for a primary residence, you need at least 80 to 200K. Going at my savings rate of 60K per year, I knew it would probably take me about 1.5 to 2 years to save for a down payment. So that was my next objective. Like, I just want to save for a down payment, continue exactly what I'm doing. And then I bought my first house for $800,000. I put 20% down. So it was $160,000. And what I did was I house hacked that property. So it was a 4-bedroom house. For me, I was just used to staying in one small, like 10 by 10 room. But on this house, I was living in the master bedroom, which was huge. It was like at least 600 square foot, believe it or not, like a master bedroom. I had 3 other bedrooms and I just thought I'm used to having roommates because, college mentality. So I literally just advertised my rooms on Craigslist, Facebook Marketplace, which is like the new Craigslist. And I just said, hey, fully furnished rooms, you can rent it for $1,000, including utilities. That sounds a bit crazy to people, but in California, like the average 1 bedroom is at least, depending what market, like 3,000 to maybe upwards of 5,000 in San Francisco. To them, it was pretty cheap. And I was able to lease out all the rooms. So I was getting $3,000 a month, which covered my mortgage, and I just had to pay the property tax, insurance, and utilities, which came out to be $1,500 a month. So I was still living relatively cheap. And in a weird way, I was paying myself because I'm paying kind of myself $1,500. So that's how I really got started. It was just very organic. I just wanted a place for me to live. And I just thought I don't need 2,300 square foot for myself. So let me just rent out some of these rooms while I can still tolerate having tenants with me. Right.
Yeah. House hacking is such an incredible way to get started. I know we talked about it on your podcast as well, because we still house hack our basement here in Colorado Springs and pretty much live for mortgage free in Colorado, which is fantastic and has definitely helped accelerate our investments and our ability to save by taking one of your biggest expenses and turning that into somewhat of an asset. So that's awesome. And I'm sure that's been really beneficial for you as well to continue having that savings rate and getting started into some more deals in real estate, which you really just took off on and had some really rapid growth. And I don't want to understate that. So let's get started talking about, hey, what did it look like as you house hacked that home and into the future of your real estate investing journey? Take us there. Let's hear a little bit more about that.
Yeah, let me share the timeline. I bought my first single family home, which I house hacked back in 2017, right? And I down 20%. I only need to down 10%. I just want to do 20 because that's what I was trained to do, at least initially. But after that first property, I actually got another job near San Francisco and I couldn't do the commute. So I just said, okay, I want to buy another house where I want to put 10% down this time because with primary residence, you can do less than 20% down. And I was able to find a makeshift duplex in San Francisco. It's actually more common. It's not a legal duplex in the tax record, but it had a separate entrance for a lower unit and a top unit. So I did the same thing. I got a house in San Francisco. It was $1.1 million. I put 10% down. That's $110K. And I lived in the upper unit, which was a 3-bedroom, 2-bath. So I lived in the master bedroom, rented out the 2 other bedrooms for $1,200 each. And then the bottom unit was like a little own apartment complex, right? It had a separate entrance to the side. It had 2 bedrooms, a bathroom, and it didn't have a legal kitchen. It just had a wet bar. So a wet bar is just a sink. And then for the stove, you just kind of do the plug-in countertop ones that you can buy like Costco. So that's the difference, right? But then I rented it out to 4 college students because I was nearby SF State. I was renting it out, that bottom unit, for I think $2,800 to 4 students. So once again, between the rent from the lower unit as well as the tenants sharing with me, I was getting around like $5,400 a month. And that once again covered my mortgage. I just had to pay property tax insurance, which came out to be roughly around like $1,500 as well. And then what I did is I just rented out the last house that I owned. But that house, when I rented out, California, unfortunately, prices are very high. The rent isn't as high as you would like to cash flow. So I was renting that one out and I was probably negative cash flow about maybe $500 a month for that. So that's my first step. And then in 2021, that's when I really started to scale. So in 2021, I relocated to Southern California, where I'm currently at. As you can tell from my formula here, I did the same thing. I bought a house for 10% down. This was during COVID. Interest rates were below 3%. So I literally got this house for $770K, 10% down. Interest rate was 2.7%. Back in 2021. Look at inflation today, right? It's not even near that, but I actually bought that house, had the intent of actually living in it, but fortunately was laid off from my job. So I had to relocate to another place. So I ended up just renting out that house completely. And then I rented an apartment for myself. And I just said, okay, I've been having roommates for the longest time. I want to enjoy myself and have privacy. I have a significant other, a girlfriend at the time. You want a little more privacy. You don't want to share rooms as much. So that's when I pivoted a little bit and just said, how can I buy real estate where it's a little more cash flow? Because California, for those who don't know, it's all appreciation. Like the first house I bought for $800,000 in 2017, fast forward till today, 6 years later, it's worth $1.3 million. So that's $500,000 of equity, right? But that property, as I mentioned earlier, it was negative $500 a month first, probably 3 years. But when I refinanced it to a lower interest rate like I did today, and I raised the rents, now I'm just breaking even. But I'm self-managing my property, and that's not including for any CapEx, like any maintenance, right? But it's more of like a forced savings account is what I call it, right? Like in the Midwest, you can get $300 in cash flow, but the properties will never appreciate. Versus California, I could literally sell my asset, 1031 exchange this into a huge apartment complex, and utilize my $700,000 equity to get a big apartment complex that cash flows. So, that's why kind of my strategy is. So sorry, I tangent a little bit there, but in 2021, that's when I started to do out of state real estate. I looked in Alabama, Huntsville, Alabama. For those who don't know, that's a aerospace capital. There's a lot of rocket scientists there, literally. And I bought a brand new build for $260K and my rent was $2,000 a month. And I was cash flowing $800 a month. And that blew my mind. I was like, wait a second, I can buy a brand new build house, no maintenance issues for at least the next 10 to 15 years. There's still warranties on the property. This thing is being rented out for $2,000. That's close to the 1% rule. And I have property management and I'm making $800 a month. I said, geez, I just need to buy 10 of these and I can replace my day job. So that was my plan, right? My plan was I'm going to take some equity from my single family homes and buy 10 of these. And then I had the option to leave my day job. But all of a sudden, thanks to YouTube and bigger pockets and free content, that's when I learned about apartment complexes.
Yeah. I'm going to pause you right there real quick because, man, you blew my mind and I'm sure everyone listening. So we'll take a second to breathe, but I wanted to hit a couple things that you said that I think were important. First off, for folks that are listening that are in a similar position to Stephen, there is a 0% down physician loan that does also sometimes work for pharmacists, physical therapists, dentists. So that's something to look into too, that you could potentially acquire one of these homes for 0% down and still house hack it. Probably is not going to cash flow as well, right? Because your overall loan balance is going to be higher, but that's still an option if you don't have the cash to put down the 10% on the house in California. you can potentially do 0% down. And you can stack those just like Stephen did, move into another one, do the same thing, move into another one, do the same thing. So that's a great way to scale. And you did it too. You just put a little bit of money down, which probably decreased your risk and also definitely increased your cash flow going forward. What blew my mind was you said, hey, I was losing $500 a month on this property, $6,000 a year ballpark, and you have $700,000 worth of equity in that home at this point. And all the time we hear cash flow. And I think cash flow is great for protection. It's great if you want to get out of your job. It provides that security. But you have $700,000 worth of equity just from buying this house that you can tap into to buy these bigger assets or to invest or to use that and put it in stock market or bonds or something that's safer that you can then draw off of if you want to still get that quote unquote cash flow. So I think it's really cool because a lot of time we talk about cash flow. I love cash flow, but what a cool appreciation play. And that's, correct me if I'm wrong, probably been vital to your success going forward, which we're about to hop into the apartments and the rapid scale there. But yeah, really cool story. And I think it can be replicated by folks listening to this. And man, the last 17 minutes, go back and rewind and listen to that again, because that was awesome. Thanks, Stephen.
Yeah. And what I will say, because I have a high income W-2, obviously not as much as physicians, but I could take that